and I will welcome everybody. I see we're getting some people still coming in. Good afternoon, everybody. This is Lawrence Baxter. I'm hosting this panel today. It's on the Archegos implosion, which is featured in the financial news for the past few weeks, and in which we are hoping to cast some light on the different dimensions of it and possible suggestions for reform as well. I want to introduce to you our speakers. First of all, Lee Reiners, who is the Executive Director of the Global Financial Markets Center here at Duke Law School and is sponsoring this program. Gina Gale Fletcher, who is a faculty colleague and derivatives expert. Jim Cox, I think, virtually needs no introduction, but the SEC expert, and Elizabeth de Fontenay, who is a leading private funds expert as well as a securities expert. And so I'm delighted to have been able to put together this panel, which really produces expertise on every dimension of the Archegos scandal, shall we call it. So let me say a few words about Archegos and invite you later in the program to submit questions, which I will monitor and put to the speakers after they've had a chance to speak themselves. As I mentioned, it's every dimension of Archegos. For those of you who are not very familiar with what has happened, this is a private family office called Archegos, principally owned and administered by Bill Hwang, who has a fairly long history in stock activities and in fact was the principal of a very large fund called Tiger Asia that got into some trouble in 2012. In fact, had to make a criminal fraud guilty plea. And he renamed it Archegos and then developed a very profitable business focusing mostly on blue chip stocks in the United States and Asia, building up to an exposure of as much as $50 billion of combined leverage in the positions that the fund was taking. And usually with the technique of very large concentrated positions on specific blue chip stocks, using a leveraging device called a total return swap, which Gina Gale will talk more about. It's not a very complicated derivative in principle, but it can get extremely complicated when put together. He was able to build up a lot of leverage because there were very limited margin requirements until fairly recently for this kind of trading and position taking. And so when the stocks that he was heavily exposed to got into trouble, there was an emergency forced deleveraging by both him and the banks that had been trading with him to try to recover losses. They led to very large losses, especially for Credit Suisse, which appears to have had exposure of at least losses of at least $4.7 billion after having liquidated a total exposure that Credit Suisse had accumulated with Archegos of $20 billion. Nomura, the Japanese bank, lost apparently $2 billion. It has declared that as a loss. Morgan Stanley, $911 million. And for a context, compare that with the very well-known losses that JP Morgan suffered in the so-called London Whale trading scandal of $6.2 billion. So the combined losses here are well up on that scale. And the London Whale was an episode that created considerable cause for concern among financial regulators and members of Congress and the general public. The prime brokers that Lee Reiners will talk about made very large sums in this process trading and actually suffered minimal losses. Mr. Hwang himself lost $8 billion in 10 days. All of that combines to suggest, are there, beyond just the losses suffered by these financial entities and Mr. Huang, are there financial stability issues? And Lee will talk about those too. Now, because of the oddity of derivatives regulation relating to equity swaps, the primary regulator is not the Commodity Futures Trading Commission, which is otherwise the primary derivatives regulator, but the Securities and Exchange Commission. And Professor Cox will speak to the Securities and Exchange Commission role here and possible improvements to how this kind of episode gets addressed. I thought just before I hand off, starting with Jim Cox, I would put up a slide that shows you what a family office is. Keep in mind, there are three major categories of private funds. There's hedge funds, which are always in the news, private equity funds, which are also very prominent in publicity. And then there are family offices, which actually manage assets on a vast scale, much bigger than you would think. So think the Walton family office, for example, or Bessemer. These are very big funds. And they are largely exempt from regulation, which is what Professor de Fontenay and Professor Fletcher will talk about as well. This is what the slide looks like, and I'm just going to make it a full screen slide and share it. Can you all see that? Lee, does that show up?
I see your outline.
Oh, not the okay, let me try. I don't know why that is not showing up. I'm going to stop share and try one more time. I must have picked up the wrong thing here. Let me try that. Still?
That works. We can see it.
If you look at that slide, you will see that a large family office has a very limited point of contact of the beneficiaries. It could be one family or it could be a group of families. They can claim exemption from a lot of regulation depending on the number of families involved. But if you look at the top right-hand side, you will see the major financial activities that family office engages in. And it would be through that set of vehicles that Mr. Huang was able to engage with the financial markets on such a very large scale. So that gives you a sense of a family office is not simply a trust fund baby who is managing the family's wealth. These are very serious, very heavy duty financial firms, though they are restricted in terms of who they can receive funds from and who they can benefit. So with that background, I'm going to stop this share and I'm going to turn it over, I think, first to Jim Cox to talk a little bit about the SEC's role in this whole episode. Jim?
Okay, thank you. Make sure I'm all unmuted here. So I'm just going to have one theme here because I think the SEC's role is pretty minimal. But we have to understand why it's minimal and maybe why we can speculate about whether if it had a greater role, it would matter. So I think in the time I have, I can cover that. So as we all know, the focus of SEC regulation, with very few exceptions, is on disclosure. So that's the theme I want to pick up with. And in 1975, the part of the National Markets Improvement Act, Congress amended the Exchange Act, 1934 Exchange Act, and added Section 13F. The 13F looked like a pretty good provision. There was a belief at that point that you're already getting ideas that institutions were becoming a bigger force in trading transactions, perhaps even in the aggregation of capital someday. And so we want to have more information about who owned equity securities. And so 13F provides that if you're a financial institution and you own at the end of a quarter $100 million in equity securities. So those are key expressions: owned and equity securities of the type that are traded on national exchange. Then you have to file a report for this. And so that was $100 million. And the SEC recently said, well, gee, if we scaled that to where capital markets are today, that figure would, instead of being 100 million, would be $3.5 billion. And the relevance of that is that in July of 2020, the SEC proposed that they would raise the $100 million figure to $3.5 billion figure. That was withdrawn. And it's interesting to puzzle about why that proposal, which sounds perhaps sensible, was withdrawn, is the fact that, goes back to my theme, is disclosure is good and it's bad. Depends on which side of the argument you're on, okay? And so I'm going to take the good side of disclosure. The idea here is that if we had more transparency, my thesis would be, if we had more transparency about the positions of Mr. Huang, and more importantly, the exposure through these positions of Mr. Huang of various banks, Credit Suisse, as Lawrence mentioned, Nomura Securities, about 5 or 6 other firms. Maybe we wouldn't be having these problems where Lawrence is mentioning about the severe losses that were incurred. Yesterday's Wall Street Journal reported that Nomura's losses were $4.6 billion, okay? And the losses of one of the banks is about $1 billion. So it's a lot of money that were lost there. Maybe we wouldn't have those positions because we have greater disclosure. And my speculation for that is the following, that reading the story about these banks, it's a little bit like the don't ask, don't tell philosophy that we had some time ago and at the federal level for people in the military. And that is the fact that the banks were not very scrutinizing about how much exposure Mr. Huang had with other banks. That is that the story that's coming out is that these divisions of banks, and the bank I'll pick out is Credit Suisse, were very happy to be expanding their brokerage activity, expanding credit through these exotic derivative securities as a way of generating fees for themselves. And in fact, they were the management of that division of the bank was brought in expressly for that purpose. That is that the banks were content with their profits of wealth management, but they wanted to get into this business of lending money to market speculators like Mr. Huang. And so they brought in some hot guns there, and they started expanding greatly. The problem with their expansion of loans to people like Mr. Huang is that their internal controls, admittedly, were not up to speed. In fact, controls that most of the other banks had were not yet in place at Credit Suisse and didn't expect to be there until maybe late May to early June at the earliest at Credit Suisse. So the issue I have with disclosure here is the following. You have a lot of incentives within the bank to produce a profit because that makes you wealthy, okay? And you brought in a management team to exactly do that, take some risks, okay? Grow the business, make a lot of money for the firm. But they were doing this all the time when the messy business of having internal controls, checks and balances, and restraining the business from engaging in too much risk taking were just cast aside, okay? And they were doing this at a time where, as Lawrence pointed out, Bill Huang, what a person, not only with a history, he had a terrible history. And so this is who you're lending money to, but you just turn a blind eye to it. So the question I would have to you is, in such an environment, just exactly what kind of disciplining force would it have? If you went back to 1975, you had perfect clairvoyance then, and you were writing this legislation, 13F, and you say, yeah, 100 million, we can all agree to that. But what we want to do is not only cover equity securities, okay? We also want to cover swaps. And we don't want to just have swaps. We want to have total return swaps that Gina's going to be talking about. We want to have all the exposure wrapped up there. And would that have had any disciplining effect? That is, would there be individuals who cared a lot about Nomura, who cared a lot about Credit Suisse, who cared a lot about these financial institutions being overexposed through their lending operations, okay, to the trading activity, the risky trading activity of their clients, particularly when your client is somebody named Bill Hwang, okay? I mean, would that have had any impact at all? That's the $64,000 question. It is not, by the way, it is not the fundamental purpose of that disclosure, of making those disclosures, to discipline banks or to discipline their managers in a way that they'll not expose the owners of the bank to severe risks, as we've seen happen here. But it is an indirect byproduct of that process. So, by the way, going back to this notion about, well, what would have happened? What would have happened if the July 2020 proposals to raise the lid on disclosure from 100 million up to 3.5 billion, what would have happened? There would have been a lot less disciplining force, okay? And you say, well, gee, maybe that's the reason. Maybe that's the reason why we never saw the SEC's proposal getting any legs to itself. SEC had rulemaking power to raise this level if it wanted to. It chose not to. Who was pushing back on it? Well, it's the old thing that I got started off there, and I'm going to finish up here. Disclosure has good points and bad points, okay? It can have a terrific disciplining force. And you think that, well, by raising it, we would have less disclosure. That's bad. And who would have benefited by disclosure? Well, the pushback came from corporate America. This is why this is such a combination of business associations and market regulation problem. Corporate America said, look, we want to keep the threshold pretty damn low, because that's how we keep tabs on these people called hedge funds, activist hedge funds, people who want to come in and stir up the pot and think that management's not doing a very good job. If the disclosure level is 100, we're going to find out a lot more about these people than if their disclosure level is 3.5 billion, which is the 3.5 billion level. Very few, if any, of the activist hedge funds take such a position that size, okay? So we always think about the early warning device being the Williams Act provisions, 13D1, for example, owning more than 5%. But the real triggering point, okay, is what's happening with those movements among institutional investors with their $100 million block holdings, okay? So this disclosure is highly political, and it is fun to speculate, if you wear two hats, as I do, corporate and securities, about whether if we had a richer disclosure and the SEC actually exercises rulemaking power, which it clearly has, so that they would sweep within the 13F disclosures the types of derivatives, all kinds of derivatives, okay? To think that if you would then become a beneficial owner of a swap-based transaction, okay? And that is a matter of speculation, whether that would then have provided some greater transparency, not about Mr. Hwang, but about the officers at the banks themselves who are fulfilling their own agenda by making these risky loans with other people's money just to advance their own economic standing. So, end of story.
Well, thank you, Jim. And that actually prompts me to make the observation that disclosure, even when made straight to the face of some people taking risk within these institutions, doesn't make any difference. So GSX, which was one of the companies involved, for 2 years, the analysts have said it was a fraud, for 2 years of continued bank interaction on it. And you have to say, what part of this don't you understand? And then question the incentives to the point where the disclosures are simply ignored, even when they're made, not by the bank as a whole, but by the loan officers and the traders involved. So let me turn to Gina Gale. And perhaps, Gina, if you could walk us through the derivative exemption and total return swap. I've always loved equity derivatives because you can engage in them leaving no footprints in the market, which of course is not necessarily in the public interest. But this is a classic example of being able to engage in massive trading without actually exposing yourself to the normal structure of regulation.
Yeah, so thanks, Lawrence. So I'm going to spend a little bit, I'm going to spend my time talking a little bit about just derivatives, kind of laying out just in very broad fashion, you know, what they are, all of them, right? Just kind of using general broad language there. And I know we're probably a more sophisticated crowd, but I always find it's useful to at least lay out, you know, what we're talking about when we're talking about derivatives. And then actually hone in on the total return swap, which is what was used primarily by Huang and Archegos in this event that we're now all analyzing and discussing. So, you know, for many of us, like a couple of my initial comments will be just a refresher, but it'll set us up nicely to understand how the total return swap works, right? So derivatives are they're contracts, basically, right, that are the value of which are derived from an underlying asset, like a security, a commodity, some other asset. And with derivatives, the valuation of the derivative itself is tied to that underlying asset, because the derivative itself, it's whether you receive a payment or you're obligated to make payments, is determined by that fluctuating value of that underlying asset. Now, because of how derivatives are structured, they can be fairly risky assets to hold, or fairly risky instruments to hold. And you know, most infamously, Warren Buffett called them weapons of mass destruction, right? So they get a fairly bad rap, but there are useful, beneficial uses to derivatives within the markets. For example, you can use them to hedge or offset risk exposure, right? So if you, as an investor, for example, or as a corporation, you're concerned about the rising price of oil, like airlines typically are, you can use a derivative to lock in the future price of oil, right? So that way you're using it to hedge your price risk exposure in the future by paying a fee, a nominal, a fee based on a percentage of the value of the derivative contract to a bank or to some other counterparty in order to lock in this price in the future. Now, in the very same way that we use derivatives in this positive way to offset risk, we can use them to speculate, which is a little bit of what Jim was mentioning, right? So we can use derivatives as financial instruments to kind of speculate on potential or future fluctuations in value of an underlying asset. So again, for example, we have someone who may not have any exposure to interest rates or currency fluctuations, but they might use a derivative because they want that exposure. So they want the exposure to interest rate risk, and they can use a derivative to gain that exposure without having any pre-existing exposure to that underlying asset, so the asset that underlies the derivative. And so then they would just have a derivative that's tied to that fluctuation in interest rates. So as interest rates rise, they get a payout. As interest rates fall, then they owe money on that derivative. Now, an important feature of how derivatives are structured that's really matters for Archegos and for the Archegos example that we're discussing here is that derivatives are very leveraged, right? So they're heavily leveraged. So in order to enter into a derivative, you're just not paying the value of the underlying asset in order to enter into that contract. Usually you're paying a percentage, a fraction, and for some types of derivatives, that fraction or that percentage can be very small, sometimes as low as 1 or 2%, and sometimes actually no percentage at all, right? You can just be paying a fee and you haven't put up any cash for entering into that transaction. So this inherent leverage of derivatives makes them attractive to some investors because it's cheap. It's a cheap way for you to gain a large exposure or a large position in certain assets, magnifying your potential profits. But in the same way it magnifies potential profits, it magnifies potential losses. So if we have a heavily leveraged position using a derivative, once we have a slight downturn in the value of that asset, we can have our entire margin wiped out, or whatever very little cash we put up in order to enter into this contract, that could be wiped out pretty quickly. And so, for example, if you just think, if you're only putting up, if you have a derivative that has a notional value of $100,000, you only had to put up 1%, right? That means a 1% change in value against you can wipe out what you had to put up in order to in order to enter into that contract, and therefore and possibly snowball your losses, right? So with all that background, one of the derivative I want to focus on is the total return swap. So just as Lawrence mentioned at the beginning, total return swaps aren't super complicated, right? But their valuation can be quite difficult, right? And they can actually expose a lot of risk because they're very, very leveraged. They're highly leveraged instruments. So with total return swaps, what we have is one party who wants to gain exposure to an underlying asset. And here we'll just say stock in a company like Viacom. So you want to gain exposure to Viacom's stock price increase without actually owning Viacom stock outright, right? So if that stock increases in value, then the total return receiver, so that would be Huang or Archegos, more specifically, I suppose, is entitled to receive that increase in value, right? And any income that might have been generated from that asset during the life of the swap. And in exchange, the Archegos Huang, like the total return receiver, pays a fee over the life cycle of that swap to the counterparty that is typically an investment bank like Credit Suisse, Morgan Stanley, Nomura. And so these banks are receiving consistent periodic payments for granting the total swap receiver access to this basket of assets, or to an asset, right, to exposure to this asset. And in exchange, if the value of the asset falls, then Archegos, or the total swap receiver, will have to pay that difference in value. But if it rises, then they receive that difference in value. And so that's where we get that name from, right? They're entitled to the total return on the asset that underlies the swap. So what's key to total return swaps, like I mentioned before, is that they're highly leveraged. So we're able to use total return swaps to have a much larger economic exposure to the underlying asset for very minimal cash outlay. And so in using total return swaps in this way, Archegos was able to indirectly own more of the stock in companies like Viacom, or CBS Viacom, and other companies that it would have otherwise been able to afford and otherwise allowed to do without any disclosure, which Jim was just talking about, right? And so what's even more interesting here is that Archegos used total return swaps to in parallel, as a parallel strategy, with several banks who didn't seem to know about the extent of Archegos's exposure at the other bank, right? So they're using, Archegos is using total return swaps with several banks and having a large exposure to the same stock or the same set of stocks throughout these different banks. So there are a few noteworthy aspects to Archegos's use of total return swaps, and I'm going to try and wrap up quickly here, right? So Archegos used total return swaps to further concentrate its direct stock ownership in companies that it already owned, right? So instead of using total return swaps to diversify its holding, Archegos used it to further concentrate, kind of double down or triple down even, right, on its ownership in the same exact stock, like Viacom, like I've mentioned, Discovery, and others. And so as history has demonstrated repeatedly, when we use derivatives to concentrate risks in the markets rather than to diffuse it, the fallout can be catastrophic, and that's kind of what we saw here. Second, in addition to being heavily concentrated in the same stock, Archegos was also highly leveraged, which has been mentioned by myself and others several times here. So, as Lawrence mentioned in our introduction, right? Some estimated that the fund, that that Archegos's total positions were several times larger than its assets under management, than how much cash it had under management, right? So this meant that with that level of leverage, even slight downturns, slight changes in valuations in the assets that the fund was concentrated in and the total return swaps, because remember they're concentrated on the same assets, could have disastrous consequences, or did have disastrous consequences for Archegos, right? And so its limited cash investment was soon wiped out. Any margin it paid was wiped out, and that caused the banks that were its counterparties to start selling the collateral that they held, right? Because they were trying to minimize their losses. But then, as I'm going to mention next, this caused a vicious feedback loop within the markets, right? So as Archegos's assets declined in value, the banks tried to sell in order to cover their losses, which only further decreased the value of the assets of the stocks that were underlying the total return swap and that Archegos had in its portfolio. And so as the stock prices started to fall, the banks with whom Archegos had these total return swaps started selling into the open markets to minimize their loss and their credit exposure, which only sent the price of the stocks tumbling further and kind of led to that market-wide volatility that we saw at the end of March, when everyone was trying to figure out who's flooding the markets with all of these stocks. So eventually, Archegos, as we know, had to liquidate its holdings and experience significant billions of dollars of losses within a single day. But this was, all because we had derivatives, or this swap, being used in a way that allowed Archegos to have that level of anonymity. So it had economic exposure without having to directly own these stocks. And this caused a huge concentrated buildup of risk within the markets in a way that kind of led us to where we are now, that with the fall in valuation, it all kind of tumbled down like a house of cards. And so I wanted to just kind of provide that context here, and then and leave that for now, and then I'll be happy to answer any questions. Is that good, Lawrence? Did you want me to cover anything else?
No, just for the moment, that's perfect. We will surely come back to you. You had also mentioned something that reminded me, when the markets are rising, we see a lot of this happening because nobody knows that it's happening. So Huang was apparently earning a return of between 40 and 80% a year. Now, like Bernie Madoff, that looked fantastic until the market turned the other way on those specific stocks. And that's when, as what do they say, when the tide goes out, you can see who's swimming without a swimsuit. And so that's one of the features of derivatives. If not used appropriately, you have this huge leverage in which you never even had to own the stock. So the market doesn't even know, unless there is disclosure, no one knows. The recipe for a big chunk of the crisis in 2008. So thank you for that description. They are much more widely used, and used by organizations that are exempt, which brings me to Elizabeth de Fontenay. These hedge funds and private equity firms have been brought in within the disclosure rules far better than they were before the financial crisis, but not family offices, where so long as they stay within the exemptions they can claim, no one has any idea what they're doing, right? Other than their counterparties.
That's exactly right. So my piece of this is probably the most inside baseball, so I will try to keep it relatively short, but I'm going to actually take my cues from Gina Gale and try to go back to basics and sort of explain what the issue is here with family offices. So if you've been following this in the media, you may have gotten confused because you'll hear stories refer to Archegos as a hedge fund, and then others that say explicitly it's not a hedge fund. So what's going on here? So basically, anytime people pool their money together to be used to go out and make investments, that's what we call an investment fund. And whoever is hired to manage that is the investment advisor. Now, the regulation of investment funds and investment advisors kind of originated, like all securities regulation, very shortly after the Great Depression. And what we have is a really wildly different regime for regulating different types of investment funds. If you are a mutual fund or an ETF, that is to say a fund that is open to retail investors, so anyone can invest in them, you have an enormous amount of regulation of the fund's activities and of its holdings, its governance, and so on. So if you think of mutual funds and ETFs, they are subject to tremendous amounts of disclosure about everything. They are subject to very significant restrictions on what they can actually invest in. They are subject to restrictions on their capital structure, how much debt they can use, how much leverage, and they have restrictions on their governance. What does their board look like? Does it have to be independent, and so on? And they're restricted in what they can pay their investment advisors. Then on the other hand, if you find an exemption from that statute that regulates investment funds, then you are a private investment fund and you avoid essentially all of that. So who falls under the private investment fund category? It's largely hedge funds, private equity funds, venture capital funds, some credit funds, and so on, and family offices also, as Lawrence mentioned. So how are they exempt? They are exempt typically in one of two ways. One is they either have fewer than 100 investors, or they can have an infinite number of investors, as long as all of those investors are very large, wealthy investors, typically big institutional investors. So if you have all institutional investors, you can avoid all of the mutual fund and ETF regulation, and you can basically do whatever you want. And so, but one other piece of this is the investment advisor for these funds used to also be exempt from the regulation that we had for investment advisors of mutual funds and other things. But that changed after the last financial crisis, because suddenly everybody woke up and realized that it was a big problem, that we had absolutely no idea what the hedge funds were doing, among others, that they almost dragged down the world economy, and we didn't know the size of their positions or anything about the amount of risk that they were taking on. So now the way it works today is that almost all of those private investment funds, anybody advising those funds is actually subject to some regulation under the Investment Advisors Act of 1940. And what that means is, as a registered investment advisor, there's a few things that are important here. You do have to provide some disclosure. It's nothing like mutual fund and ETF disclosure. We have to provide some disclosure on your holdings and your investment strategy and your positions. And you are subject to constant, the possibility of constant examinations by the SEC, right? So, and that has really revolutionized the private investment fund world. They are now very focused on compliance. But there is still exemption from that piece, which exists for family offices. So if you are managing money solely for members of a single family, then in fact, you don't have to register as an investment advisor, no matter how much money you are actually managing. And so that's the exemption that Archegos fell under. We think that they were exempt that way. Part of the problem with not having them be registered in any way is we don't actually know if they were complying with that exemption, right? We genuinely have no idea what they were up to and whether they were complying even with the minimal restrictions that they were subject to. So these family offices are sort of have reared their head because just in the last 2 years, their assets have grown by about 40%, which reflects in part sort of the booming markets, but other factors as well. And the estimate is that they now hold about $6 trillion in assets. That is very significant. And as we saw with Archegos, they can have very significant impacts on the markets, especially if they are very highly levered. And so I think it's a clear and pressing question right now, whether the SEC wants to continue with this route of just exempting family offices entirely, or whether they want to switch from exempting them entirely to now having some kind of size threshold, that if you get above that, even if you're just managing a single family's money, you're going to have to register because you can take massive positions that affect the markets in the way that we saw with Archegos.
Well, thank you, Elizabeth. And that leads in well to Professor Lee Reiners, because as you think about not only the impact on the specific companies that were shocked to see their stock diving because of the fire sales, Viacom and Discovery, but the ripples that moved on to even, I understand, Lending Club is trying to figure out what happened to them because there was such volatility. You've got this problem of systemic stability, and you've also got the other piece that Lee will talk to us about, which is the prime brokers win going up and they win going down. Could you, if you can, Lee, could you explain the role of the prime brokers as well? Because there's a trading question that comes in here as well.
Sure, happy to. And before I do that, though, just a remind folks to, if they have questions, we're going to take them shortly. So you might want to put them in the chat function, and we'll get to them should time allow. But a prime brokerage is essentially a bundled group of services that primarily investment banks offer to financial institutions such as hedge funds, family offices. And it gives these institutions a mechanism to sort of outsource many of their investment activities and really focus on their investment goals and their investment strategy. So specific services offered by prime brokers include securities lending. So if a hedge fund, for instance, wants to short a stock, they can borrow that stock from a prime broker. They can, of course, get trade execution services, as Gina Gale highlighted, so they can get leverage trade execution, cash management services. Many times they get access to research. In addition, prime brokers will help a hedge fund find new investors or conduct a capital raise as well. So pretty much every major investment bank that you've heard of will have a prime brokerage unit. So Jim has already talked about Credit Suisse, Nomura, Goldman Sachs, UBS, Morgan Stanley, JP Morgan, you name it, they all have prime brokerage units. And as Lauren said, I mean, this is a very profitable business to be in because it's essentially a fee-based business. And so banks like that because people trade when markets go up and people trade when markets go down, and the prime brokers capture that fee. At this point, one of the problems of Archegos, and we've seen this again throughout history, is most large hedge funds, family offices will have multiple prime brokers. And of course, one of the issues was that no single prime broker has visibility into all their clients' relationships with other prime brokers. So, from a systemic risk standpoint, we've been down this path before. Now, not specifically with family offices, but with hedge funds. And Elizabeth gave a very nice sort of legal definition of the difference. Functionally, they are the same thing. Family offices just can't take outside funds, but they can place the same trades, get the same exposure, get many of the same services from the prime brokers that hedge funds can. So the most famous example of a hedge fund threatening financial stability is long-term capital management. And they failed in 1999. I'm sure many folks have heard of LTCM. There's a great book written by Roger Lowenstein that I highly recommend called When Genius Failed that details the story. But two of LTCM's founders were Nobel Prize winning economists. So Myron Scholes, who's you've probably heard of before, from the Black-Scholes option pricing model, and then Robert Merton. And so LTCM was highly leveraged, even more so than Archegos. So at the beginning of 1998, LTCM had borrowed over $125 billion. They just had $5 billion in equity. The notional amount of their over-the-counter derivatives exposure was 1.3 trillion. And they were able to mask this balance sheet leverage ratio of 25 to 1 because, just like Archegos, they relied on multiple counterparties and multiple prime brokers, none of whom had a complete view of the risk that had built up on the firm's balance sheet. So when LTCM imploded in August 1998, after the Russian government defaulted on its debt, it was the spark that sort of lit the fuse. The value of LTCM's positions plummeted. The firm found itself unable to meet counterparty calls for additional collateral. And ultimately, what ended up happening was that the New York Fed had to step in and organize a private sector bailout because there was recognition that should LTCM be allowed to fail, that they would probably take down one or more of their counterparties with it. And that, of course, would have spread throughout the rest of the financial system and quite likely the broader economy as well. So the government, did look into this, right? I mean, they did investigate this. And so there was a presidential working group that put out a report in 1999, and it zeroed in on LTCM's use of leverage as the principal cause. And the report provided a number of recommendations designed to constrain excessive leverage. Some of these recommendations focused on enhancing transparency in the hedge fund industry by requiring funds to disclose pertinent financial information, as we've talked about. And Congress essentially completely ignored that report. Fast forward to 2008, again, Elizabeth mentioned we had multiple hedge fund failures. There was 2 hedge funds that had been sort of sponsored by Bear Stearns. They're sort of the canary in the coal mine when they failed. And so, Dodd-Frank did try to address some of these issues. I won't get into all the details, and Elizabeth did a nice job, but certain hedge funds did have to register with the SEC. They do have to collect data and report this data. But the problem is that this data is not adequate enough. So there's sort of it's called Form PF. And the main problem with it is that it doesn't actually disclose the total amount of leverage that the fund has and who they have it from. And there are multiple ways to get leverage. I mean, simply just borrowing money is obviously one way, but as Gina Gale said, you can obtain leverage through derivatives, right? Through total return swaps. And that information effectively isn't disclosed either. And furthermore, the public disclosure of Form PF data is sort of aggregated. So you can't see the by counterparty exposure. So effectively, these prime brokers are still flying blind. Now, I'm sure their risk management systems are sort of telling them that you need to ask Archegos or whoever may be, what are your exposures elsewhere? But of course, there's no legal obligation to disclose that. And I think many prime brokers are more than willing to turn a blind eye if it's a client that's highly profitable. So, in terms of who should address this, what can we do? This is something that the Financial Stability Oversight Council was created to help address, right? I mean, this is a systemic risk issue, and FSOC has looked into whether or not the failure of a hedge fund could threaten financial stability. So in 2016, they created an interagency hedge fund working group, and they issued some preliminary reports that highlighted this data gap. And so they recommended some improvements to disclosure. But of course, 2016 was the presidential election when the Trump team took over. Many of the financial regulators used to work at hedge funds. They were none too keen on continuing this work. So the hedge fund working group effectively was disbanded. So the news more recently is, sort of FSOC is back. So not only was the hedge fund working group disbanded, but, FSOC under the Trump administration was completely neutered. There was effectively no meetings. They didn't take on, any meaningful oversight or projects, if you will. Secretary Yellen just had chaired her first FSOC meeting. Most of the focus of that meeting was on climate change and its relevance to financial regulation and financial stability. But she also announced that she was restarting the hedge fund working group. And so sort of my recommendation, not that anyone's listening, would be that this hedge fund working group should also incorporate family offices into their mandate. And I'm sure that is something that they will do. And hopefully they'll have some recommendations around, greater disclosure. But of course, the problem with FSOC is that all they can do is sort of convene in this capacity and then offer recommendations that will fall on the member agencies, principally the SEC in this case, to then implement. But I think Gary Gensler and Secretary Yellen are probably going to be on the same page. The same page here. And the final note I'll add is that, this came up actually in Jay Powell's press conference, Chairman Powell's press conference yesterday. And someone asked him, did the Fed not see that multiple banks have large exposures to Archegos? And then the reporter goes, if not, why not? And what changes would you like to see? And, Chairman Powell, I was kind of disappointed with his answer. He's very dismissive because he said, in the grand scheme of these large institutions, Archegos risk were not systemically important. That may be true in this instance, but it doesn't guarantee that it won't be true in the future. And then he went on to say that he was troubled that this could happen in a business for a number of firms that is thought to be relatively well understood risk, which again, history would tell you that is not the case, that these risks are not well understood within prime brokers. So we'll see what will happen, but certainly we have plenty of historical reminders that hedge funds right now, family offices can potentially threaten financial stability. I mean, 10 billion total losses associated with Archegos is nothing to sneeze at, including 5 billion at Credit Suisse. I mean, that's a significant hit to earnings and a significant depletion of capital. So I hope that this is a wake-up call for financial regulators. Lawrence, you're on mute.
Sorry about that. Thank you, Lee. I want to come back very briefly to a couple of things you said, but invite questions in the meantime. I see some of our distinguished alums out there. I almost feel like calling on them, but would love to hear from you. Let me just return to a couple of points. First of all, people are listening to Lee. He very modestly said, not that his views count. I happen to know they are listening. So, Lee, your modesty outruns your ability in this respect. Secondly, just to emphasize the systemic element, long-term capital management, which you talked about, and was this very celebrated hedge fund disaster when the Russian ruble turned direction. They lost 4.6 billion in 4 months. Well, Credit Suisse lost 4 to 5, maybe as much as $6 billion in a few days, and Mr. Huang lost $8 billion in 10 days. And if you put together, Wells Fargo got out of it, they were lucky, they had properly hedged, as did a couple of the other banks. Mizuho is only now well, they have not announced yet whether they had losses, but they are only now investigating it. This raises a couple of things about derivatives. First of all, they're meant to be hedged. Many of these positions were not properly hedged, which is why they were one-way losses. And the second thing, back to what Gina Gale talked about, if you look at the very large derivatives markets, most of it's made up of interest rate and foreign exchange derivatives. But those are between banks and are usually extremely well hedged because the prudential regulators watch it very carefully, and the banks themselves don't want to commit suicide by taking stupid positions. When it comes to equity derivatives, it's a very different situation. First of all, it's not only silent in the eyes of everybody else because it doesn't involve buying any equity or selling it. But secondly, it's often not well hedged because the market is not nearly as open and liquid as it is with interest rate and foreign exchange derivatives. That's actually the reason those two sets of derivatives are not even regulated by the CFTC or the SEC, because the bank regulators watch that very carefully. So equity derivatives are growing in popularity for the reasons we've already talked about. And we've already seen bigger losses. Now, admittedly, it's a much bigger economy than it was in 1999, but nevertheless, this is just one incident that happened in a matter of days. And the other irony is that Mr. Huang already lost a lot of money when Volkswagen stock turned direction in 2012, which is why his activities were exposed at that point. This is not to suggest that he's been dishonest in this situation, but you would think that banks would not want to commit suicide by simply escalating their exposure to somebody who has quite a track record. What we've seen again, as in the run-up to the financial crisis, is individual business people, whether they be bankers or funds managers or that, get seduced by returns. And that 40 to 80% return that Mr. Wang was delivering was obviously hypnotic to some of the parties in the banks that were willing to keep extending, even after investment analysts had said one of the stocks that he was exposed to, they suspected was fraudulent. So this is difficult when we don't have transparency. And that gets back to Elizabeth de Fontenay's point about how this very large scale business can go on with almost no transparency at all. Well, I am very tempted to call on Ryan Clements, who I see back there, and who is an ETF expert. And Elizabeth, you mentioned ETFs, and I'm not so sure that they're quite as well regulated as I know Ryan would like them to be. It looks almost like he's left the room hastily.
No, I'm here.
There he is. Here you are.
Hey, guys.
Hey, good to see you.
Wonderful to see you all, too. I actually have a question going back to Lee's point, because on ETFs, I've done a whole bunch of work, as you know, on the non-bank SIFI rules and the changes to away from entity towards activity-based. Lee, on this point for the family offices, do we need to open that question up as well? Or is the activity-based framework sufficient to deal with this here? Or is there some entity dynamics that we need to look at as well?
Yeah, that's a good question, Ryan. So, it's hard for me to imagine that an individual family office would rise to the level of like systemic importance, right? I mean, I would hope that BlackRock, for instance, would be designated before um, a family office would. So, I think that the activity-based framework, and for those who maybe don't have all the background, there's really sort of two things that FSOC can do, and then the one that sort of has the most teeth, if you will, is that they can designate non-bank financial firms as systemically important. And with that designation comes heightened supervisory attention and scrutiny from the Federal Reserve. And so initially, when FSOC was stood up, they designated a handful of firms as systemically important: GE Capital, AIG, MetLife, Prudential. I might be missing one, so Ryan can correct me there. None of whom sort of all have been released. They've been freed from their cage, so to speak. Some of which because they downsized, they shrunk. So GE Capital, basically shrunk. But others, the Trump administration was sort of a more sort of willing ear, if you will, and de-designated these firms. And when, in addition to de-designating them, they said, okay, we're no longer going to look at systemic risk from this entity-based perspective. We're actually going to look at it from activities. So rather than say, BlackRock is systemically important, we can look at asset management as being systemically important. The problem with that then is like, okay, even if you decide then that asset management is a systemically risky activity, then what can you do about it? And the answer is not much other than make recommendations that they hope will be implemented by the member agencies. So, the SEC, the CFTC, the Federal Reserve. So the activity-based approach just doesn't really have a lot of teeth, I think, is the main argument. And I think the solution here is really disclosure. I mean, Jim touched on it. I mean, I think everyone who spoke has sort of touched on it, because if the prime brokers have insights into the total exposure that their clients have elsewhere on the street, then they can do what you would hope would be proper risk management, and they'd be incentivized to engage in proper risk management. So I think that's ultimately what has to come from this. But as Lawrence just said too, I mean, if a client is very profitable, it's hard to say no. It's hard to walk away from that. And they can just go down the street. So, provided that there's always sort of one prime broker willing to do business with a firm, it'll be hard to sort of eliminate this risk entirely. But I do think disclosure, sort of sunlight is or transparency is the best disinfectant, right? Certainly applies to this case.
Any other thoughts, Ryan?
No, I think that that's a good perspective. I'm, as you know, I'm skeptical, excuse me, of, the speed that is required in order to, or the speed at which these contagions can precipitate, and where instability in one area can all of a sudden move into other areas, and how in the context of a crisis, nonlinear reaction can start happening. They kind of makes both the, unless you're in an ability to have already determined that the entity in question might have this contagion potential. The activities-based framework is really hard to I think cut off. And there's been a lot, when the rule changes were being made, there was a number of submissions made to the FSOC from, actually Janet Yellen as well, just stating this issue about having an activities-based framework. Things move too quickly to be able to do anything once they've actually happened. So I like the idea of disclosure. But yeah, this is one area, as Elizabeth already mentioned, that, for once the ETFs aren't in the news right now. The ETFs are in the news for other reasons.
Yeah, right.
Crypto being one of them in particular. But in this particular issue, ETFs actually have a lot of disclosure. It's just a question of whether or not, investors fully understand that disclosure, and whether or not we're on the other side of the disclosure, which is, information overload, which is an issue, or comparability when there's 7,000 ETFs, and the really important things like tracking error and arbitrage instability aren't they're opaquely disclosed. It's not entirely clear how to be able to compare funds side by side. That's an entirely different issue, but
Right.
we're in a heavily, we're in an extreme disclosure mechanism, but maybe not usefulness of disclosure. So reviewing how we disclose things on the particular issues of these complex products or something that's an important discussion point as well.
Well, and we were very fortunate that the market didn't suddenly turn down, because it was those isolated exposures to specific stocks that were the problem. But if the market as a whole turns down, Wall Street on Parade has added up all the exposure of this kind, and it's very big. So if we hit something like anything remotely like 2007, 2008, this is going to be one of the areas where we see the fallout that we never saw coming. So I should have mentioned Jim Cox had to leave at 1 o'clock, so that I want to thank people. We're out of time now, but first of all, Jean Gentilette and Elizabeth Fox for putting this all together. Thank you very much. I want to thank our guests for joining us. Thank you, Ryan, for being dragooned in unexpectedly. But if I see your name anywhere near, we've had such a deep relationship. You're one of our colleagues. And then thank you to the speakers, Gina, Gail, Elizabeth, and Lee, and of course, externally, Jim. So we're out of time now, but I hope that casts some light on Archegos, and I don't think it's the last time we'll see something like that happening with private funds.
Thank you, Lawrence. Thank you all.
Yeah.